My pleasure to be with you all here in Charlotte this morning. I just drove up. It was a 2-hour drive from the University of South Carolina, so not all that bad for me, and thank you for traveling such a distance. I've just basically started my 4th year at the University of South Carolina after 23 years in the insurance world and a couple of years in government research work before that, and I'll be sharing some of those experiences with you, but this presentation is a little different maybe than some of the ones that many of you have seen me deliver in the past, in the sense that usually you see me show 50 years of combined ratios and 100 years worth of net written premium growth by line, by state, by country, and so forth. I will not do that here. It'll be more of a perspective on the state of research in the world of insurance, where it is, where it's heading, what sort of potential I think it brings, and the value that I think it brings, and just thinking a lot about this conference and who would be here, and sort of my perspective in academia, but also keeping an arm and a leg in the private sector has given me, I think, kind of a unique perspective on this I'd like to share with you. This presentation is already available on uscriskcenter.com, and that is a new website that we've created, and very shortly it will house dozens and dozens of exactly the types of presentations that I told you about on every imaginable topic, mostly related to property and casualty insurance, personal, commercial, and on a global scale, and a lot more as well. So please visit that website for additional content as we move forward. But again, this presentation is already there. So when we think about the presentation I'm going to give today, I'm talking about what I think is a much needed renaissance in research. And this is probably not confined to insurance. In this era of big data, we hear about disruption just about every sector. We have to think about the rebirth, the renaissance of research just about everywhere. And this is all occurring in an era of innovation, and again, we've heard the term disruption several times already. You will hear me say that I believe it's the most overused word in the English vocabulary right now, but also ambiguity. So innovation, disruption, all of these necessarily breed ambiguity, and ambiguity is a big important area, of course, for people engaged in research. So we'll talk about my view that insurance really is the original big data industry. I've said that for many, many years, going back to my many years in the insurance world, and really the roots of that trace back to antiquity. But we're not that far removed from attributing just about everything that happened to everyone and everything to deities of various sorts, finally discovering the utility of data and the fundamental and rudimentary rules of statistics and probability theory not that long ago by human history standards. And today we find ourselves in a period of disruption in what many people call the 4th Industrial Revolution, where we are now essentially entering into an era where we're interconnected digitally and separating ourselves from what would have been the 3rd Industrial Revolution not long ago. Innovation. Certainly we're seeing a lot of that in the world today. Current period is one of rapid technological innovation, but I will say that if you're a student of history, you probably know that periods like this are not unprecedented. In fact, as humans, we've gone through quite a few, and certainly quite a few even in the past few centuries. When we think about industrialization, if we go further back with respect to the advent of agriculture, and so on. But today, what we talk a lot about, of course, are things like artificial intelligence and machine learning, and I know you'll be talking about that later on in the program. But of course, again, the word of the day, disruption, it is not solely technology-driven. I think many people think of disruption and they think solely of technology and the variety of technologies coming out of Silicon Valley. We will talk about that, but there's a lot of disruption occurring both socially and demographically, economically, geopolitically. You need only turn on the television in the morning. And each morning in the bathroom of my house there's actually a television. I'm in South Carolina, so that forces me to turn it on to Fox News first thing in the morning. I go downstairs and have breakfast, then I watch CNN for an equivalent amount of time. And I swear, there's absolutely nothing that these two stations have anything in common. So it's very interesting listening to these sorts of things, and you can hear about the geopolitical and political instability around the world. Voting on Brexit today, for instance, has significant implications for the global insurance business and reinsurance markets. And we'll conclude with a discussion about ambiguity and how that's a necessary byproduct of periods like this and the role that insurance can play. Because after all, what we are doing in a period of ambiguity that results from rapid innovation and disruption as we are humans are left where we are always left. Where is that? Grappling with uncertainty. How do we manage uncertainty? But first, let's think about insurance research today. And I wanted to take a look at its scale and its scope. And the way I'm going to do that is I'm going to break it down into what I call positive and normative approaches. Okay, so you may remember way back in your Economics 101 class, for instance, what positive analysis means. And when we think about it in the context of research, this means looking at the world in the way that it is, the way that the world is today. And what this does, this approach, this positive approach, lends itself to discussing and testing, for instance, cause and effect. Very important, of course, in the world of insurance. And it's based on tested facts. It's based on descriptive statistics. It's based on objective analyses. We'd all like to say that's how we approach our jobs. But the reality of it is we are not free from bias, and there is a lot of uncertainty in the world. There are also differences of opinion. And so that lends itself to normative analysis. So in general, when we look across any industry, if we look across any academic department, we can look at a normative analysis approach, and that describes the world the way it should be. So as insurers, as ratings agencies, as regulators, whatever we are, we all have an understanding of the world the way we believe it to be, and we all have an understanding of the world the way that it should be. And of course, there's going to be a lot of difference of opinion, particularly on the normative analysis side, but it's very, very important. In our normative analysis, what do? We make recommendations, presumably informed recommendations. But they're not necessarily based on tested facts of hypotheses. The recommendations are more prescriptive in nature. We should do this. We should do that. Then they're more subjective in nature, in the sense they're more personal opinion, potentially. And you can see that in the presidential race right now. Very different views on how our health insurance system, for instance, should be operated and run and financed. Very, very different points of view. Okay, there are some positive analysis, of course, on the health insurance side, testing various types of health schemes across countries, for instance, but there's a huge normative component to this. So what if we were to apply this to insurance? When we think about positive analysis in insurance, this should describe how insurance markets work. And here's my little bit of a bias here as an economist and someone who teaches corporate finance as I think about insurance markets, okay? There are other things that are out there as well, but markets is very broad here. We're talking about everything from consumers and consumer demand to how insurers operate, to how they finance themselves, to their capital allocation to systems and everything in between. Okay, but how do insurance markets operate? So for instance, some examples would be, are credit scores predictive of loss? Well, that's a hypothesis we can test, and in fact, it has been tested. And definitively, credit scores are in fact predictive of loss. Tort reform lowers casualty claim severity. Well, that's certainly the case in certain types of tort-sensitive lines. Medical malpractice, professional liability would be good examples of that. Do distracted driving legislation, does distracted driving impact auto claim frequency? I would say absolutely that the testing of this hypothesis bears that out. Restrictions on underwriting criteria lead to adverse selection. I could go on and on and on in terms of decades and decades worth of positive analysis, some of it very, very useful for public policy that has originated with the insurance world that has in fact been very, very helpful to society at large. But when we think about normative analysis in insurance research, you might be thinking, it doesn't really have a role. We are about testing for correlations, for instance. We do only want to know about those things that are predictive of loss or help us reserve better or those sorts of things. But that's actually not true. That would be sort of a narrow way of looking at things. We should ask ourselves, how should insurance markets work? Not just how they work, but how should they work? It's clearly not the case, for instance, that the U.S. healthcare insurance system is running optimally today. Okay, it is the most expensive on planet Earth, and we don't have better outcomes. Why is that? All right, that means there is a role for normative analysis here. So, for instance, we can make statements such as health insurance is unaffordable. I haven't tested that hypothesis, and how unaffordable it is relative to other countries, and what can we do to make it more affordable. So it's a normative statement, but nevertheless, it's a normative statement that I think can lead to useful research. Insurance rates should be capped. Many opponents of the insurance world have, at various points in time, believed that's to be the case. And whether Florida homeowners insurance years ago or in other areas, it happens routinely. Gender-based underwriting should be banned. In the European Union, they've agreed on that. In the US, we don't agree on that, right? Generally speaking. Now, insurance is systemically risky. That's one of those issues that came out of the financial crisis. Some people believe that it is. Some people believe that it is not. In Europe, they believe it is. In the United States, we no longer do, okay? We used to, but we no longer do, okay? So, I mean, these are interesting questions that I think positive and normative analysis bring out. So when we think about this a little bit more, so how would we best describe the state of insurance research today, currently and historically? All right? Is it more in the camp of being positive analysis, or maybe more in the, is it normative in nature? Are we more prone to describing insurance markets, how they work, dealing with the concrete facts and the testable hypotheses that arise from those facts, or are we more prescriptive in nature? Are we so troubled by the state of insurance markets today that much research needs to be done in order to make the market welfare enhancing for all consumers, to operate more efficiently in the interest of the investors in this world? Okay? And so these are a lot of questions. But if you actually drill down and you take a look at it, insurance research today, the work that you do, the work that I or my colleagues do, and other academics might do, it is a combination of positive and normative, and much research actually has elements of both. In the years that I've come into the academic world, I've done far more. I grew up on the property casualty side, but I've spent a lot more time in the world of health insurance since I've come to the University of South Carolina. And in that particular universe, you see an enormous amount of research that is done that is both, that has elements both that are of a positive and normative of nature. We're trying to test hypotheses or alternative hypotheses, and then we develop some sort of conjecture that comes out of that, some recommendations that come out of that. Now, the problem with insurance research is that apparently everybody does it, okay? When we look at the breadth of entities that conduct research as broadly defined into the world of insurance, certainly academic institutions, the insurers and reinsurers themselves, many of them represented in this room, sponsors of this event, but also every segment of the industry. Agents and brokers have their own particular issues that they are concerned about. Naturally, they sponsor research into those areas. Trade associations have issues they are concerned about, and they're going to be different on the life and health side as they are on the property casualty side, and many subgroups have their own trade associations also. Investment analysts have their own perspective on research. They are conducting research for the benefit of who? For the investors, the people who are pouring money into your companies and could put it somewhere else with a click of a mouse, okay? That's important to remember. Ratings agencies who are trusted with what? Making sure that insurers basically don't go under. They're not entrusted with that, but they are monitoring that. And that gets me to regulatory agencies who, of course, are entrusted with the prudential regulation of insurers, ensuring that, above all, that you do not become insolvent and unable to make good on the promises that you have made, along with many other things. And then there are legislators who are concerned about, should I pass a particular piece of legislation related to insurance markets? Will that lower prices? Will it raise prices? What will it do to availability? What will it do to the cost of insuring a home here on the coast of North Carolina? That kind of a thing. Think tanks, public policy organizations, many of whom at various points in time are hired or endeavor to conduct some kind of research related to insurance markets. Industry critics, groups like the Consumer Federation of America, Okay, they do studies. Okay, you could take issue with the studies that they do, but nevertheless, that's how they refer to them, and they characterize them, and they may be characterized in the media that way. Okay, so that is a form of research, whether you view it that way or not. It is done. Consulting firms, some of whom we have here, do lots of studies related to the insurance industry. It's a big practice, the insurance industry, for consulting firms. Technology firms, increasingly, in the insurtech phenomenon, which we'll be talking about later. Of course, very interested in this business. Venture capital firms have become very interested in the insurance world. Hadn't historically, but now they are very interested. Law firms, of course, law firms see the insurance world, depending on what side, as a client who spends a lot of money on defense or is an entity that should be sued. And either way, there's a lot of research that goes into this. And then, of course, the media. I spent a lot of time in my life dealing with the media, and the media doesn't necessarily do studies as we would traditionally think about it, but they will sometimes say that they do investigative research, okay? Where they allege to have detailed some sorts of behaviors or some such thing on the part of insurers. And of course, it's incumbent on insurers and their associations to be well aware of that. So here we have literally 15 entities that in one way, shape, or form conduct formal or informal research, and so that gives you a sense of the breadth and the scope of research. It's vast. It is vast. And there are people who live in silos in various parts of these various entities here, and they'll never speak to one another. Okay? Now, I would just tell you sort of just in the last few months, and at a university, I'm exposed to many more things than I would have been exposed to, say, just running a property casualty trade association, things that I get asked to do. Okay? Well, to work on an issue where a particular state wants to ban the use of genetic information in life insurance underwriting. Okay, another, affinity group pricing. Another state wants to ban the use of affinity groups for pricing purposes. Okay, how do you set a penalty interest rate for an insurer that has litigated a claim and eventually lost? So how do you set that? All right, so that appeals, so those sorts of things come to me as kind of an academic who spent time in the insurance world. The appropriate taxation of reinsurance, the appropriate tax, when is reserving excessive, at least from the perspective of the IRS, to the point where they might view you are dodging your taxes. Okay, mutual insurers, how are they distinct from stock insurers? Even very recently, looking at the energy insurance market impacts of China's Silk Road initiatives in the Middle East, North Africa, and South Asia. That was a very interesting little project. Then, distracted driving, working on a project there in the state of Georgia. And of course, InsurTech is one of those things. So very, very interesting. And I'll even mention that the issue of development of talent now is something, of course, that we, of course, at a university think a lot about, but more and more of you thinking about how to develop talent, not only to be the next researchers in the world of insurance in the future, but to better your organization. But I will tell you how things over a long career come around. My very, very first research project ever, and giving away my age almost, but I had just joined NCCI as a relatively new Ph.D. Down at their headquarters in Boca Raton, Florida. So workers' comp, I'm in the actuarial group there. And I joined, it wasn't more than a few days after Bill Clinton had taken office. It turns out that Bill and Hillary Clinton had the idea that they were going to essentially reform the U.S. healthcare system, and effectively the federal government would wind up delivering and financing healthcare, and they had proposed that this would include all of workers' compensation. So I thought, I've made a terrible career move here, and my very, very first assignment was in fact to conduct research into why it would not make sense to have the entire workers' compensation system subsumed into some national health care system. And that was my very, very first research project, and it's very interesting how we hear on the candidate, at least for the Democrats today, we hear about single-payer systems and so forth, although not really, I think, proposing to absorb workers' comp. So, from the world, so what I'm going to do is kind of take a whirlwind tour around the world of research right now and talk about what are the sort of things that are being discussed. So let's start from the ivory tower, from which I I hate to use the word descended because I'm not, because here I feel like I'm very much among peers, okay? But what I want to say is that the world of academia does sort of live in an ivory tower oftentimes. And so here are two leading journals in the world of risk management and insurance, Journal of Risk and Insurance, and a sister publication of Risk Management and Insurance Review. If I look at the most recent issue of the Journal of Risk and Insurance, and I tried to blow this up as much as I can here, but hopefully you can read some of these. What are some of the topics that are being discussed? They do look very positive in nature, how cell phone bans affect automobile insurance markets, the effects of prescription drug insurance on hospitalization and mortality. These sound like really, really important sorts of positive sorts of analyses. And in some sense they are, although when you get into many of these articles, they descend into incomprehensible mathematics. All right, so the titles are very attractive oftentimes, but what you take away from it is sometimes diluted by how they get there. And so it winds up not necessarily being as applicable as you might have hoped. But suppose when you look at, so you see life, health, property, casualty, all sorts of types of important issues being discussed here. But it is ultimately very, very academic in nature. If I have a discussion with the editors of this journal, and so this is the top journal to publish in if you're an academic who's focusing on a risk management and insurance issue, and I know some of the editors personally, this is literally the list of what they are trying to encourage nowadays for research. So this is what they are looking for. Okay, if you want tenure, you're better off trying to publish in some of these areas. Research into health insurance markets. That makes a lot of sense. Health is almost 20% of the U.S. GDP, and there are a lot of problems there that remain unresolved. Big and growing right now in the world of research, and this is coming out of the world of economics and finance, is behavioral research into risk and insurance. Okay, actually studying in experimental situations how consumers behave with respect to risk-related situations, okay? Again, this is coming out of the area of applied behavioral economic research, which has become very, very big in the world of economics. Same thing in finance as well. So that is kind of overtaking a chunk of research in the world of risk management insurance today. Quantitative risk management, again, so thinking hard about how when we think about things like enterprise risk management in particular, how ERM can be optimized in organizations, and then more recently, big data techniques, digitalization, and insurtech. Okay, so these are the four areas that the leading journal in the world of risk management insurance on the academic side is working hard to encourage today. If we look at a sister publication, which tends to be a little bit less intense in terms of the underlying mathematics and in theory. You see other important issues being discussed here as well, but governance issues, for instance. Maybe most people in this room don't think about governance and risk management, but again, when we think about ERM, okay, governance, of course, is where that all begins and ends. But fundamental questions about the demand for insurance. What is driving the demand for insurance? Special country sorts of situations are commonly. So if we look at in any given issue of these things, you'll see special studies related to 1, 2, 3 countries. So a lot of interesting things being done out there in the academic world. But there are commitments to research beyond the academic world. The Casualty Actuarial Society, probably have some actuaries in this room, I know we do, has a multi-decade commitment to research, and importantly so. And if you look on their website, a large part of their website is dedicated to research that they make available to all their members. Just looking at some of the most recent monographs that have been released, stochastic loss reserving using Bayesian, I think Monte Carlo models. Okay, I'm sure you all read that before you came down today. But it is. But again, these things are important because it's trying to improve the way that. If you think about it this way, loss reserving is the #1 cause of insurer insolvency historically over the past 50 years. So it makes sense to work to improve insolvency, to lower insolvency risk, okay? And how about something a little more new, a machine learning approach to parameter estimation, okay? So machine learning, kind of an application of artificial intelligence, so on the very cutting edge of what's going on. So this is very, very important research for actuaries and others, quantitative types in organizations. And so, again, the research commitment to the CIS, I think, is truly extraordinary. But other topics, many of which you've had to grapple with and no doubt done research on, areas like climate change and cyber risk, and again, more technology-related risks, predictive modeling methods, just really an endless list of research, and again, really great work is done by them. But if we move on to, so we went from academia to the actuaries, let's go over to the distribution side of the business. It's probably true you aren't going to see many papers on the website of the Council of Insurance Agents and Brokers or any agents association that have to do with stochastic methods and Monte Carlo analysis, okay? That's probably true. But what are they focusing on? Their focus areas right now are healthcare, cyber, insurtech, and the globalization of the business. It makes sense. Because when you go over to the distribution side of business, the most lucrative part of the distribution side is actually the benefits business, okay? When we're talking about group health, those kinds of things. Right? So not surprisingly, and of course with all the transformations going on in the healthcare sector out there, they want to keep on top of that. Obviously, the way that insurance is being sold, to the extent more of it is being sold online through direct means. Okay? So when we talk about cyber and insurtech, all of these things, when we're talking about the digitalization of the industry, it's extremely important to the distribution side of the business to be on top of this. That's what their members care about. In fact, when you look at the Council of Insurance Agents and Brokers, what they call market intel reports, like mini research reports, the Affordable Care Act leads the way, InsurTech over the past 5 years. InsurTech is second. Employer-sponsored insurance. They feel threatened by, say, a single-player plan where there might not be any employer-sponsored insurance. Cybersecurity, digitalization, healthcare reform, single-payer systems. So you could see there's a much more concentrated, the issues are much more concentrated, of course, because we're dealing with one segment of the industry, the distribution side. And the distribution side really accounts for 10 to 12% of all revenues in the business. So, but if we move along to a commercial broker now, commercial brokers right now, and we look at, say, a Marsh, for instance, Marsh and the other brokers do a lot of great work in particular markets that are emerging and that need more information. They provide a very, very important role in terms of making information public that, quite frankly, only the largest brokers have access to. They see the pricing and demand information across large-scale commercial accounts. They know what the supply and demand trends are. They are between the supply and demand. They are the broker. They're matching up the supply side, the carrier, with the demand side, the ultimate client out there. And so great work for years now on, for instance, cyber. Or if we look at work that I use frequently in the Willis, with Willis that comes out on energy-related markets, because that's one of the areas I focus on in my own sort of private side of things. Great work in there, which is very difficult. Aon does a lot of great work in the area of political risk, which is very important this day and age, of course. And many organizations have done work in the area of climate risks. So again, this is just representative. It's giving you a sense of how vast the world of research out there, but it continues. My first job sort of in the carrier world was with a reinsurer, was in fact with Swiss Re. And in their research group in New York. I was the first hire in their research group in the United States, and I have a distinction that's long lost in history. Now, many people might be familiar with the Swiss Re Sigma studies, which are phenomenal. I wrote the first one ever that was ever written in English, okay? And it was on health insurance markets. They had previously always been written in German because they had been written in Switzerland. I wrote the first one that had been written in the United States. But so I don't have any to sign for you to hand out here later on. It's probably available someplace. But again, so great work by reinsurers, again, because they have, like brokers, reinsurers are sitting on top of a lot of accumulated and aggregated information. They have a perspective that most of us can't have or don't have. So utilizing their resources, and quite frankly, they've been extremely generous to companies like Swiss Re and Munich Re and others with just providing, I think, very, very vital research that benefits the entire industry and also very useful from a public policy perspective. And you look at recent work from Munich Re, for instance, on Brexit. How could that be any more timely? So we're talking about risks out there that need research, but maybe not in the traditional way of thinking about it. So Sigma, this particular, most recent Sigma talking about data analytics, very, very timely. The middle one talking about a major blackout, for instance. Think about it as kind of a disruption to utilities as a result of a cyber risk. All these things are very interesting. What if we go to the analyst side? What do we see? I follow many, many analysts. And of course, what they are looking at oftentimes are event-driven measures that affect profitability, okay? And so if we look at a recent report from Barclays Capital, Hurricane Dorian could be a meaningful event for insurers. Turned out it really wasn't. But that was the report. They're trying to give their analysts a leg up. What will their analysts do? Their analysts will send out that report to their paid, to their clients, and their clients will base a decision on whether to sell the stock in the event of an impending hurricane. Looking at earnings reports for various companies. What should I do? Should I buy Chubb? Should I hold Chubb? Should I sell Chubb and AIG? What should I do? Okay, so that is research, and they call it research. You may not think of it research, but they call it research, and they believe to every extent that their research is as important, as valid as everything that you are doing in this room. And it is. Because ultimately, their research is what touches the investor. Okay? And as someone who teaches corporate finance and talks a lot about the informational role in markets, it is exceedingly important, the information that gets out there from various forms of research. So many of you have the opportunity to provide direct value to your company or to your industry by making sure that the information that is the most important is getting out there, and it becomes ultimately investor and customer facing. Okay, so, and also regulators, when we think about regulators and ratings agencies, again, AM Best, a long-standing commitment, a lot of great work done by AM Best also. I love to read their reports, and if we look at other organizations, you may not think about it as research. If you look at the NAIC's profitability by line, by state report, and many other reports that they put out, it's just reams and reams of numbers. And you might say, well, that's not really research. But actually, many of the numbers in there, it's a result of a complex calculation, and accumulation and collection process. In my view, that counts as research. It may be raw data that you can use or benchmark your company against, but I find it very fundamental to what we do. So the scope of research, the point of all of this, is that the scope of research is extremely broad, and it's growing. But the problem is, or the issue is that we all live in our own little research silos. I live in one maybe now, partly in the academic world. You live in one because you're at a commercial carrier. You live in another because you're in a personal lines carrier. You might live in yet another because you're at a trade association and you work in a regulatory environment. So your research is largely directed as a function of the needs of your employer. That's not surprising. That's what they pay you to do. That's how you demonstrate value added. But it does mean that we live in silos. And nowadays, insurance research is broadening to include more of a focus on technology, business solutions. The explosion in data and analytical capability also broadens scope. And it's a good thing, but it's a lot to get your arms around, which is what I'm going to be talking about in a minute. The scale of research that is going to be conducted or needs to be conducted is expanding rapidly. Insurance is a vital, highly regulated industry, and it guarantees a high volume of interest in everything that we do. So as researchers, the volume of what you do is going to have to scale up. So we're left with a question of quantity versus quality, of course. And also, with more data and more information, there's the question of objectivity versus subjectivity, which just gets us back a little bit to the positive to normative approach. So the moral of the story is, when it comes to insurance research, where you stand is where you are, okay, or is where you sit. Okay, it's whatever is important to your organization. Are you a client-facing organization or public policy, legislative, regulatory? Is it internal? Where are you? The scope of insurance research is extremely wide. I think wider than most people even in this room think about it. and it is expanding rapidly. And so researchers in many of these cases will find that their work overlaps with the work of others. They may not be aware of it, but over the course of one's career, it's possible to work on many issues that are entirely mutually exclusive from one another. And I have had that experience many, many times in my life. So, a good example would be, sort of mutually exclusive issues that occur daily in my career now, for instance, is again working on single-payer health insurance systems in the workers' comp line and what the impact might be on workers' comp versus energy insurance markets and geopolitical risk in the Middle East. They have nothing to do with one another, but they are all important issues that deserve research in the world of insurance and risk management. And if we look at, I was able to come across some data on worldwide R&D expenditures for non-manufacturing industries. And what you see is, so obviously insurance, part of the world of finance, non-manufacturing. In the world of non-manufacturing, who spends the most on R&D? Not surprisingly, software publishers, computer systems design, data processing, physical engineering, life sciences, leave us in the dust. And then below that, we have finance and insurance. And unfortunately, finance and insurance are not broken out in the data. I suspect insurance is actually probably maybe a quarter of that number. So in our segment of the world, who's spending the most in the non-manufacturing side? Not surprisingly, technology firms, not in the actual manufacture of equipment, but again, software is leading the way. But this is a big business, and finance and insurance, and we're going to have to spend more. Now, just to kind of get back a little bit here, when we think about the origins of insurance and risk management, we don't actually have to go all back that far, because for the majority of human history, what happened to people, the socioeconomic groups that you belong to, and the environment in which they lived in was attributed to the will and the whim of the gods, okay? The view that humans are not passive before nature is a relatively new concept. I love telling this to students when I teach an introductory risk management and insurance course, okay, that we are not that far separated from hauling people up to the top of a temple and cutting out their heart and sacrificing them to the gods after an eclipse, okay? We're not that far away from that, okay? Fortunately, between then and now, we've had a few smart people come around like Bernoulli and Leibniz, the father of calculus, the father of modern statistics, who began to understand during the period of the Renaissance things that I find, very, very interesting comments. This is an exact quote from one of these geniuses to the other. Nature has established patterns originating in the return of events, but only for the most part. In other words, there's information in terms of the events that happen out there in the world. It's not random, it's not chaotic, but nature does not exactly replicate itself, but in fact, but there are patterns, and we can work with that. So these are, these 17th, 18th century light bulb moments represent the origins of insurance research. If risk results in patterns, it must be measurable. If it results in patterns, if it's measurable, it must be treatable. That's the origin of risk management as we know it today. And the language and the measurements and methods that all of you use today and take for granted are actually relatively recent inventions. There has been, and there remains, institutional resistance to this sort of approach. Religious, cultural, political barriers to the interpretation of nature, okay, through the lens of science or statistics, okay, has, been problematic through the centuries, and it exerts influences even today. Okay, so, and in humans, and also we have to think about such things. When we think about behavioral research into insurance and risk management and economics and finance, we have to understand that humans, when it comes to risk, we face risk everywhere all the time. We are terrible at risk perception, terrible at risk perception. For most of the history as species, we have just simply been exceedingly superstitious. We do not do a very good job of estimating probabilities, particularly over the run. And so I mentioned this. So literally, I went to the roof of our office building. We had a total eclipse here a couple of years ago, and I thought it interesting to take a picture of this before I had one of my classes, because again, as I mentioned, it wasn't long before where that eclipse would have resulted in that scene that you see over there on the right-hand side, kind of a Mayan sacrifice. But anyway, that is not how we innovate today. We're in a new world of innovation. We are in a world of innovation unlike we've ever seen before. what is this chart saying? This is the number of U.S. patents from 1836, when the U.S. Patent Office opened, till today. Okay, and what we saw is it took 155 years for the U.S. to issue its 5 millionth patent. It only took 27 years to issue the next 5 million patents. That's opportunity, and all that opportunity needs to be insured. Okay, we're talking about intellectual property that represents both tangible and intangible risks. Nothing has ever been invented that didn't have risk associated with it. So when we hear that we must be running out of things to insure, it's difficult to find. There's not a lot of bricks and mortar anymore. How is it that there were 5 million patents in the last 27 years and we're having difficulty finding things to insure? Research certainly can help with identifying those. Now, and also, when we throw on top of that the pace of new data creation, which is what many people are thinking about here in this room today, we are looking at an exponential increase in the amount of data being created globally. So in the early 2030s, real-time data for the first time will exceed non-real-time data. You can see right now, non-real-time data still exceeds. But what we are seeing is that the compound average growth rate between 2019 and 2025 for real-time data is 39% a year. This is measured in terms of Zeta bytes per year. And non-real-time data is increasing by 24%. If you're like me, you have to look up what a zettabyte is, so I put it down at the bottom of the screen, and now I made it so small I can't read it, but I believe it's 10 to the 21st, so it's 21 zeros after it, okay? It's equal to one zettabyte is 1 trillion gigabytes, which is the largest thing that we typically use. So we are talking about this. So you must think, wow, all this data is great. It's awesome. Okay, more data is always better. Guess what? Most of it's unstructured. Okay, and it's coming from largely from social media platforms, of course, and other things as well. Just take something like the autonomous vehicle. One autonomous vehicle, as it's driving around on an average day, generates as much data as about 2,600 internet users. By the way, you are an internet user at this very moment, okay? You're on your phone. You're probably not on it right now because you're engrossed in this conversation. But what is happening is as you are sitting there, you are generating 1.6 gigabytes every day. A car is going to generate as much as about 2,600 people per day. Think about that kind of thing. All right, so that's truly extraordinary. So are insurers ready for this? No, you're not. You're just not. Okay, there's no way that you are ready to handle this amount of data that's not flowing in the way exactly that you need it to flow in. When we're talking about such things as how much insurers are spending on IT, well, it's pretty extraordinary. Right now, insurers are spending a pretty substantial share of their budget. Global P&C in life and health, IT spends about $220 billion since 2019, according to Gartner. About 8 to 10% of that is outlays for data and analytics nowadays. That's pretty extraordinary. And that equates to about 3% of the global insurance industry's expense base. So that's getting really, really specific nowadays. So data analytics accounting for about 3% of the expense base. Now, in the era of disruption, we've had disruption up and down the industry's value chain, from distribution to analytics to who owns the data. Is it the consumer? Is it the insurer? Is it some other intermediary who actually collects the data nowadays, say the car manufacturer? And ultimately, although less disruption, although even there's some, in terms of who is the capital provider in this business. But I wanted to talk briefly, when we hear about disruption nowadays, we're hearing a lot about insurtech. And these are some trends you'll probably see also later. This is insurtech funding over the last 7 years. What you see is it seems to kind of reach the peak at around, I don't know, $1.5 billion a quarter or so. And the majority of it is P&C, accounts for about 70% of all insurtech funding today. And in the early stage of insurtech funding, it seems to maybe be coming down a little bit now. And we've got still the majority of it is property casualty related. I'm going to talk about what is happening to insurtech funding and why in a minute when I put on my finance professor hat. But let me just quickly run through these. What you see on the P&C side is you see There's less investment on the carrier side nowadays, and more of it is associated with B2B. More of it's on the carrier side, less is on the distribution side, but we see an increase in B2B, whereas on the life health side, we see more investment on the distribution side. When we look at reinsurers and insurers, their spending remains relatively strong, but it's probably peaked. Looks like 2019 is going to come in roughly where 2017 and 2018 is. There is a huge list of companies, both traditional venture capitalists and also traditional insurers and reinsurers that have invested in the business, in the startup side of things. So here's a couple of investments, observations that have occurred to me from observing this. So the actual risk-bearing insurer startups are rare, and nobody, including venture capitalists, is clamoring for this to change. I think this is something different than what people expected a few years ago. There aren't a lot of new startups, and basically almost none of them are profitable in terms of actual risk-bearing insurers. In my view, insurtech investment is far more complementary to insurer operations than it is disruptive. It's basically outsourced R&D. It allows insurers to kind of pick and choose. Insurtechs prefer to partner with smart money investors nowadays rather than venture capitalists who don't have any particular expertise. Insurtechs are going where the money is nowadays, and the less naive money is coming in, but more of it is going into areas like data analytics, business processing enhancement, rather than into startup risk-bearing carriers themselves. My view is that the valuations of basically almost every firm out in Silicon Valley is inflated. I've been saying that for quite some period of time. That will include insurtechs, and I think I've been proven absolutely right recently when we look at the many debacles that have occurred with respect to IPOs that have been pulled for other companies. Aren't related to insurance, but it's indicative of what's happening out there. The fact that you have a cool idea, you call it insurtech, doesn't make it economically feasible necessarily. By calling it disruptive doesn't make it economically feasible. And so in the interest of time, I'm going to skip over why I think most insurtech firms are doomed to fail. But I'll just get right to this part. Higher interest rates relative to when this kind of venture capital boom began, it makes all venture capital investments less attractive. A lot of IPO busts recently, not just the pulled WeWork, for instance, but things like Peloton, Lyft and Uber, Snap. You can name a lot of other ones. In general, a lot of problems out there getting these companies out. Why? Because they're not really profitable. Profits really matter. And when you don't have a path to profitability, investors are finally beginning to realize that. And I think that's going to cause some collapse in funding. And the problem is that look at the record number of IPOs out there recently in the dot-com world with no earnings per share. Earnings per share less than zero. I teach corporate finance also. Earnings per share greater than zero are a good thing. In fact, they're a necessity over the long run. With no path to positive earnings per share, I think increasingly we're going to see more concern with that. So let me skip over this part and just come to a conclusion because I've run out of time, I think, as many of these guys will run out of cash. Just conclude with the issue of ambiguity, okay, the final point. So more data on its own does not necessarily lead to less uncertainty. I think we have a tendency to think more data is better data, but you have to manage data, and all of you know that. So just to bring you back to that chart about the patents, the amount of data that is coming in through these additional 5 million patents we've seen in the last 27 years, or the ones we've seen in just the past few years, is astronomical. This is what is leading to that rapid increase in the amount of data that is being produced and accumulated out there today. So, but these patents and the other, the entrepreneurial attitude we have here and around the world, it's opportunity. This is the growth engine for the insurance industry. And opportunities that meet the standard criteria for insurance, for insurability are inherently uncertain. Okay, when new opportunities arise, are they all insurable? Well, maybe not right away. This uncertainty gives rise to ambiguity, especially for new risks that are creating these opportunities. So it's kind of a circular argument. Think about in recent years, last 5, 10, 15, 20 years, terrorism, cyber, climate risk, commercial spaceflight, many of the life sciences. We are just scratching the tip of the iceberg when it comes to these various types of risks. And so the ambiguity reflects the residual uncertainty even after the application of underwriting resulting in less than full insurance. That is the result of ambiguity mathematically, is you wind up not fully insuring. So we are growing, we are learning while we are doing in many of these particular areas. So can we reduce ambiguity quickly enough to capitalize on the opportunities that arise from innovation and disruption? Well, time has suggested over time, I won't go through my mathematical example here, but I will, but time has suggested that, yes, as an industry, 100 years ago, we didn't know what we were doing insuring cars or airplanes, but we figured it out, okay? And I have every reason to believe we will figure it out now. So I wanted to end on the ultimate ultimate ambiguity, politics, okay? So I'm going to end with a question. Since 1950, under which president was the U.S. P&C insurance industry the most profitable in terms of ROE? Anybody have an idea? It's not Donald Trump, okay? Okay, here Reagan, and that's the most common answer that I get. There's a second part to the question. Since 1950, under which political party has the U.S. P&C insurance industry been the most profitable? Republicans or Democrats? Now I'm hearing more Democrats out, so we got some Reagan fans and a few Democrats over here. But here it goes. As it turns out, we were never more profitable than we were under Jimmy Carter. And I found this out from research, okay, by looking at the industry's profitability all the way back to 1950. And why was that? Very, very high interest rates in that period of time made the industry very, very profitable, something we don't have today. I'm sorry? And then, does it matter who's in office? No. It's about 7.6, 7.7% Republicans and Democrats. It does not matter who's in the Oval Office. Why? Because hurricanes, earthquakes, and so forth really don't care who's over at 1600 Pennsylvania Avenue. Okay? They just don't. So anyway, that, just to conclude, again, the scale and scope of insurance research is vast and is increasing rapidly. That means you all have your work cut out for you. New approaches that come about as this record amount of data is generated. We need new technologies to manage it. We hear a lot about AI, machine learning. They offer promise, but they have a long way to go. So disruption and innovation have always, in the long run, benefited this industry. Whether you're on the life side, the health side, the property casualty side, it doesn't matter. They have benefited this industry. And it's likely, in my view, no different this time, although it can be a scary, bumpy road along the way. So thank you very much for your time, your attention. Sorry for going over a few minutes, but that's what professors do. Okay, so thank you very much.